Hey everyone, me Kevin here. In this degenerate episode of Beer with me Kevin, we are of course going to have carrots, Stella. So, look, we just got to be transparent here. I would love to be bullish. Unfortunately, I still think the Fed is substantially behind the curve, and in this video, I want to give you a little bit of insight into why I believe that the Federal Reserve is substantially behind the curve. First, I'm not here to fearmonger. You know, I've got call options on quite a few different positions, but they're positions that I think do well in a soft landing or recession. We talk about that in the courses. You know tonight there's a coupon expiration at 11:59 p.m. California time. You already know that. MeetKevin.com. You know what to do. Stocks and Psyche, all my alerts, my positioning, everything. You already know that. But I want to show you this. Take a look at this. This right here is a chart that was screenshotted today of the Atlanta Federal Reserve. And it is a chart of the GDP now real GDP estimate. Okay, so it's ticked down a little bit, but who cares? This is very volatile. Ignore this. This does not really matter. This is up and down all the time. Big deal. But instead, I want you to pay attention to that boring paragraph right there that nobody reads. Stella. And carrots. So, see that right there? You notice anything special about that paragraph? Most people don't because they bold the part they want you to read. The GDP model estimate for real GDP growth in the third quarter is 2%. And then everybody stops reading. But wait a minute. Last week I complained that the second sentence indicated a 0% growth rate in something called real gross private domestic investment growth. Now that's a mouthful. If you can remember that would be the equivalent of shoving one of these in your throat and not dying. I'm allergic to carrots, by the way. But anyway, real gross domestic. So in other words, inflation adjusted investment in America. And then the growth rate of that, okay, decreased from 0% to negative 2.4%. Now, this is just one of the things we're going to talk about in this video. But what does that somewhat signal to us? This. What I did is I went back past the... Oh, that's gross. Bro! Silverfish! Oh! Silver newspaper. Gross. Bro, you can't just attack me like that. What the hell? That's gross. Problem solved. So what I did is I went back to the post-Korean War. So in other words, the period after the Korean War. The reason I did that is because domestic investment growth generally declines in a war because you redirect your factories towards spending for military equipment. So I counted negative real domestic investment growth, which is basically when the blue line goes under that black line across the bar there. And they put a red arrow every time it went negative around a recession and a green arrow every time it went negative not in a recession. And what you can see here is that of the 14 times that it went negative, 78.6% of the time it went negative in a recession. Just 21.4% of the time it occurred not in a recession. One of those times was the mid-'80s. One of those times was approximately 1967. One of those times was approximately 2016. Note, though, 2016 was barely negative at about 1.4%. The mid-'80s were negative down to about 4%, and as were the 1967 periods. So it's possible we could still be one of these green arrows, but let's just say the odds are somewhat against us. When this number starts rolling over, it's bad. But it's not just this number, folks. It's, frankly, the Federal Reserve starting to freak out. And this morning, when I listened to Jay Powell speak, I'm like, man, am I the only one who thinks this guy's freaking out right now? And no, because later in the day, take a look at some of the stuff that we saw. From the ING group, or ING, we got major downward revisions to U.S. jobs pushes the Fed to act. The weaker labor market momentum that we noticed, where we thought we had 2.9 million jobs and it only ended up being 2.1 million jobs thanks to the Bureau of Labor Statistics revisions, has pushed the Federal Reserve basically into panic mode, is their argument. Absolute panic. Now listen to what they say here. They say oftentimes the Bureau of Labor Statistics is actually accurate, but usually they're only accurate during what are known as steady times. They're actually typically inaccurate during the most important times, turning points in the cycle when they tend to be significantly wrong. And they update their forecast to suggest that they are going to look for a 50 basis point cut in September and then 25 in November and December, because they think the Fed's done effed up. They think the Fed's screwed up and has messed up the jobs market now. That yes, inflation is not a problem anymore. It's jobs that matters. And so then I wanted to see what Deutsche Bank thinks, and Deutsche Bank thinks the same thing. Larger initial cuts would require more disappointing labor market data than what we've seen to date. In other words, in English, if we get a big miss in August for the, in September for the August data, we might get ourselves our 50 basis point cut. And it's not exactly going to be bullish. Look at their little summary here. In summary, while Powell's Jackson Hole speech emphasized greater confidence on the path of inflation, he spent more time, folks, you know this, we covered this, outlining risks of further unwanted deterioration in the labor market. In turn, the upcoming labor market and growth data will more likely determine the initial size and pace of policy easing. It's true, J. Powell didn't close the door to anything. And on top of that, if you look at Rabobank's scenario number 2 for artificial intelligence, they basically give 4 scenarios. They say, look, in one scenario, everything goes to the moon. Productivity goes up, demand for AI goes up, everybody is a winner, everything's great. Then they've got these like other edge case scenarios which I think are mostly nonsense. Like I think it's possible that everything could go up, but then they also have this example of like everything stagnates and nothing benefits from AI. I don't really believe that. They have this example of demand surging for AI, but not getting any productivity out of it. Maybe I'd put, this maybe at a 20% chance. The other one I just read, maybe at like a 2% chance. Demand surging and surging, probably also at like 20, 30%. But the one I would put at 50% is right here. And this is the one I want to read you. And then when you combine all of this, you start getting nervous. Watch this. In the second scenario, there is still this extensive set of AI tools that raises productivity. This makes sense. There are a good amount of AI tools that raise productivity, but not all of them do. And we assume, though, that the industry has a very steep learning curve, which means that AI functions become widely available at low price points. It's like price wars to basically get you to use their chatbot. Well, we're already seeing that. This is not a surprise. Cheers to that. AI getting cheaper, baby. Woo! The marginal cost of many AI tools and user queries falls to zero. In other words, the benefit of you building out your server stack is stupid because it becomes a commodity and like an extra query doesn't actually cost anything. That is not good news for AI stocks and doesn't feed into the AI investment boom. Keep in mind that scenario number 1, which I do give like a 30% credibility chance, is basically everything just goes to the moon. And so yes, it is possible that everything goes to the moon. I don't think it's as likely as this second one, where basically we build so much compute that you basically lower the cost of marginal AI compute to near zero. And then in the short time span, it will require no macro significant upfront investment in order to implement these tools in the workspace. Everybody gets to implement the tools in the workspace. But the problem with that is it's not just Americans who get to do it. You now risk outsourcing work to AI-assisted workers in developing economies, which means more joblessness in America. And folks, right there is what I'm concerned about. Because I try to position, look, people don't want to hear it. People don't want to hear it. Just gonna be transparent here. Listen to myself say it because I want to make sure I'm saying this appropriately. Okay. Folks, I personally am positioning my portfolio so that I can run my startups whether we go into a recession or not. The positions that I am investing in right now are killing it. Like they moon today. It's because I have like 7 figures of call options on 2 different strategies and both of them moon today. I mean, a lot of things moon today. But these strategies moon, in my opinion, in a soft landing, in which case all stocks moon, like Tesla and Nvidia, Apple, whatever, all that stuff, or a recession, in which case I don't think everything moons, only certain things moon, specifically some of the things that I've invested in, which I mean, call me biased. I obviously position because I want to prepare for either a soft landing or a recession. So just join the courses on building your wealth. You'll know exactly what it is. You can see sort of my allocation. But anyway, coupon expires today. There goes my phone. Dang it. Anyway, the problem here is that the Federal Reserve might be significantly slower than we suspect. This is a really big deal. I want to draw this out for you for a moment. Let's throw in a new page here, and I want you to see why the Federal Reserve might be panicking in a little bit more of a detailed manner, especially now that we have a little bit more insight from some of these institutions. I want you to ask yourself, what does minus 50 basis points do? It takes us down to 475 BP. Okay. What does another minus 25 and a minus 25 do? It takes us down to 425 basis points. That's where we sit with interest rates, right? And the middle is obviously 425 or 450. So now you have to ask yourself, is that actually going to stop the layoff cycle? The layoff cycle has not even started yet. That's the real concern. We're getting rigged jobless data. And I'll tell you, there was a lot of upsetness over the Bureau of Statistics Bureau of Labor Statistics late release of the data for the revisions because certain banks got the data before everybody else. Yeah. The suits that everybody's like, oh, the suits got the data before us. They got the data way before us. Messed up. And this time it was blunt. It was blatant rigging. Now, we could chalk it up to a mistake. But the point is, we have substantially weaker labor data. What does that mean going forward? Well, it means we're going to highlight the importance of some specific dates coming up. The dates you want to write down in your calendar, if you have not yet, are JOLTS on 9/4, ADP on 9/5, and most importantly, non-farm payrolls on 9/6. We have been growing payrolls an average of about 176,000 jobs. We were told it was closer to 250,000, but thanks to the revisions, we're actually down under 180,000. And the odds are that since that was only a March to March revision, the odds are April, May, June, July, whatever comes after that, all of those months are all low as well. That's not good. That means what we've been told is probably even worse than expected. This last labor report that made everybody panic, the July labor report that came in at 114,000, take the revision off of 114,000. Bro, if you take 90,000 off of that, you'll be down at 24,000 jobs for the month. You know how bad that looks? That's a recession, bro. And jobs data lags. We all know that. So, look, people are like, Kevin, just join the bulls already. I swear, I want to. I so badly want to be a bull. But I also want to be transparent. Look at this. Folks, see this? See that? Dude, can I really be bullish at 425 basis points of rates? No. I'll go bullish at 0 to 150, baby. That's 0% to 1.5%. That's where your boy Kevin wants to go bullish and go on margin and go all in on Tesla and the YOLO stocks or whatever. I don't care. Think I want to go bullish at 425 walking into an election and a potential recession? Hell no. Bro, I'll buy the 30-year treasury and twiddle my thumbs milking 4% for the next 30 years because you know what? There's a real possibility we'll never see 4% on the 30-year ever again. Got carrots. They're supposed to make your vision better. I'll let you know something. It didn't work for me. Anyway, bro, oh my God, how did that get over there? All right, what else? So we talked Deutsche Bank. Oops. Talked Rabobank. There were some other institutions that I was reading some research on as well. Not as many of them as I thought actually ended up talking about Jackson Hole. I think they all kind of took an early Friday off. Freaking losers. I'm filming this at like 9 p.m. It's like already midnight on the East Coast. Good thing the coupon doesn't expire until midnight on the West Coast. But anyway, this is crazy. If JPOW is panicking because they went too far, they need to start doing 100 basis point cuts, not 50, certainly not 25. They need to get this stuff down ASAP, because even if you get down to 2% right now, it's not going to stop the layoffs. It's going to take 6 to 12 months for that lag to actually encourage hiring again. That's scary. Sorry. I want to be bullish, but I can't be. Not on these stocks. You know, the big ones that have been popular. I've picked some other ones that kicked ass today. And one of them was up like 9%. And then I had like 6 figures of calls on it. That's why I'm having a Stella and carrots. Anyway, I got a little date coming up with Lauren, so I'll see y'all in the next one. Also, what do you think? I moved the mic down low. Do you like the down low? I know everybody's been used to kind of like the mic out of the shot, but I don't know. I have to say, I kind of think it looks cool. Look at this. Did you know? Look at the arm of it. I bought that arm black. I got it black. And I turned it gold. I'm like Kanye. All right. I'll see you in the next one. Love y'all. Bye.
These things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.